Tesla shares moving lower this morning after the EV maker missed on both revenue and earnings for the first time since 2019. The stock was flat following the release, but took a turn lower during the earnings call when CEO Elon Musk struck a pessimistic tone, saying he's moving through the current environment with a degree of caution. Joining us now with more, Gene Munster, Deepwater Asset Management managing partner. Gene, good morning. I was just looking at the beginning of the third quarter. The estimate for the third quarter for Tesla was, I think, at 84 cents in earnings. The estimate got whittled down to 73. It comes in at 66. A lot of focus on the automotive margins once you exclude those vehicle credits for zero-emission vehicles. So where does that leave us here in terms of the earnings power, how much more they're going to have to deal with in terms of price cuts and margin pressure, and how does it feed into the whole story?
Well, margins are the critical point, Mike, and ultimately they need to improve those margins. Musk was clear, don't expect margins to move higher over the next year as they start to ramp Cybertruck. And so this is really the battleground. This is the center vortex of the whole Tesla story. It's about margins. Margins go up, that means that this is a tech company. Margins go down, it's a typical car company. And so that's why there's so much weight on that all-important automotive gross margin X credits. And I would just frame in one other detail there. It was 16.3% in the September quarter. It was 29% a year and a half ago. These margins are now approaching traditional automakers. Now, granted, traditional automakers lose a ton of money when it comes to their electric initiatives, but they are approaching those lower margins. And so, Mike, what does this mean? It means patience is a virtue. Elon talked about this being a challenging period. He used that phrase twice in his prepared remarks. He did not talk about challenges in the June quarter. And what essentially the setup here is that investors who believe that this is a tech company, I'm one of those, have to wait an extra year plus before we start to see some of those margins improve. There was another layer of disappointment on the call, too, is Tesla has been steadfast with this 50% compound growth expectation. And Elon started to back off with some of that language, saying that it's just impossible to continue to grow at those rates. And so when we think about Tesla and the story for the next 5 to 10 years, that 20 million vehicle number in 2030 just got a lot harder after his commentary last night. And so that's the near term. It is disappointing. I am optimistic for longer term reasons, but it was not a pretty quarter.
Right. And, you mentioned that the margin profile has been trending toward traditional automotive companies. It's not there, but it's getting in that direction. As well as, Elon Musk complains about high interest rates. So they're having to cut price to create demand, whereas before it was all about supply constraints and unlimited demand. In other words, the story that got Tesla to an $800 billion market cap is not really there anymore, at least right in front of us, and it trades at 70 times earnings. So it's obviously a great operator with all these advantages, vertical integration and everything else, and certainly massive first mover advantage in EVs. But what do you pay for it?
Well, ultimately, I think you probably pay 5 or 6 times revenue. And the question is, what is the revenue going to be in the next 2, 3, 4 years? And this is, I think, where people need to look in the mirror and ask the question, which is, ultimately, where is the world going when it comes to transportation? If the answer is maybe it's an electric world over the next 10 to 20 years, then Tesla's not going to get there. It won't get the bid that to keep the stock going. If the answer is that the world is going in that direction, I think the company is in a great position. And the reason why is that this addressable market, gets back to your question about what do you pay for this? The addressable market for automotives is massive. If you take the low end, it's just over $2 trillion a year. The high end, it's $2.5 trillion. The smartphone market's about $600 billion a year. So this is 4x the size of that. Tesla's got a pole position. General Motors just announced that they're backing off some of their plans to do for their light truck production facility. They basically postponed that by about a year and a quarter. The other automotive makers just are backing off on EVs. And so I think this is the period of where great companies have difficulties. And ultimately, I think that they will come out. I think you pay 5 or 6 times revenue. That's a hardware software model that Apple has. And where does that get you to? They'll do call it $25 billion in revenue next year. It probably goes to $500 billion over the next several years, and you can kind of fill in the multiple there.